In today's video, I will be telling you about some of the things that I've seen others do that led to their failure as dividend investors, in the hopes that you can learn from their mistakes and use their experiences to help you succeed. Failures might range from a little financial blunder to the complete abandonment of investing. I have personally learned more from my failures than from my accomplishments, so setbacks may be valuable if you learn anything and don't quit. But first, please accept my warmest greetings if this is your first visit to our Smart Stocks Academy channel. To be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. So if you're ready, let's get to the video. The number one reason why dividend investors fail is that they do not stay totally dedicated to their long-term goal of building a dividend snowball. Perhaps they believe that a snowball takes too long to grow. So they shift gears and invest in get-rich-quick schemes, which, paradoxically, frequently result in get-poor-quick schemes. People begin dividend investing because their prospect of passive income appeals to them. But somewhere along the way, they begin squandering their funds on items they don't require, since ascending the dividend mountain appears to be too sluggish and difficult. Stocks are not a way to get rich quickly. Treat equities as if they were companies they represent, which should be producing amazing things and providing appealing services. If you find yourself focusing solely on the enormous upside possibility rather than understanding the substantial downside risk, you may be failing. I receive remarks all the time about how dividend investing is too slow. Those same folks who want to get rich rapidly are frantic to get out of a job they do not enjoy. The bad news is that dividend investing is a long-term strategy for achieving their aim of generating passive income to eliminate their need to labor for others. No, it will not happen overnight, but you can do it if you have the patience. Many dividend investors fail because they lack the patience required to be successful. Yes, you start slowly at first, but as time goes on, you go quicker and faster. And when you finally reach there, the experience is incredible. In the last 25 years, the market has closed green approximately 53 to 55% of the time, implying that it has closed red 45 to 47% of the time. That may not sound appealing, but consider a casino where the odds of winning are usually only slightly better than 50-50. To be clear, if you do your homework, investing isn't gambling. You will notice that company stock prices tend to trend with their financial results in the market. They don't always, but over time, they tend to return to the mean of their financial tendencies. Just because the market has trended up in the past does not indicate that it will continue to do so in the future. But I believe you can improve your chances of your success by investing in outstanding rising firms. Please do not have the idea that you have to make money quickly in the markets, as many newer investors do. Some people overestimate their talents and are so confident in themselves that they take more chances than they should and end up getting burnt. Or they start out super confident and then give up when things go wrong. Another mistake I find with dividend investors is the erroneous belief that if a firm was previously excellent, you don't need to stay close to it to ensure it continues great. However, there are several examples of businesses that have lost their shine over time. Take a look at GE's dividend history, or the revenue trend to see what I mean. My argument is that you should not be overconfident in your business. Sure, they will probably do great, but every now and then, a company can lose its relevance and refuse to evolve. Those who underestimate their abilities are the polar opposite of those who overestimate their abilities. They second-guess themselves, suffer from analysis paralysis, and believe they will never be wealthy. They do not begin investing because they lack confidence in themselves, or they begin and stop after a period of poor performance, or they do not invest because they do not believe they have enough money to begin. But $1 invested is better than $0 invested. To succeed in the markets, you must continue to invest. Anyway, Another reason dividend investors fail is that they do not understand some of the fundamentals of dividend investing. Just this week, I received a comment from someone telling me about their fantastic dividend stock. My first red flag was that I have never heard of it, and when I checked it up on Seeking Alpha, I discovered that the firm had gone 10 years without increasing its dividend and had 0 consecutive years of dividend growth. I then looked up its overall returns over the previous 10 years and discovered that it had returned less than half of the SP 500. That doesn't mean that the guy informing me about his amazing dividend stock was making a horrible investment. Who knows? Maybe he got in at a terrific price, or maybe it was part of an RSU grant or something. But it is not what I would call a great dividend stock. Anyway, I hope you get my main point, which is to always learn the intricacies of what you want to invest in before you do so. Because sometimes people don't, and then they get burned and then they stop investing. Another reason I've seen dividend investors fail is when they do not spend enough time learning about taxes and then have to deal with a tax difficulty that could have been avoided. They don't grasp the advantages and disadvantages of a taxable brokerage account versus a retirement account, for example. They are unaware that even if their dividends are DRIP, they are often deemed taxable income at a taxable account. Another way I see dividend investors fail is that they put too much money into high-yielding stocks in the hopes of getting rich faster. They don't take the time to learn all of the details of the businesses they are investing in. Instead, they look for a greater dividend yield and buy some shares. More yields are frequently accompanied by higher risk, which can result in larger losses and lower overall returns. Investors should be aware of the differences between many types of dividend companies available and why their yields are what they are. In addition to understanding yield, investors need to be aware of other financial measures and trends. When you don't know the essentials of a possible investment, you are setting yourself up for failure. Another common blunder I see is when someone invests rashly based on a hot stock recommendation. I think it is great to listen to other people's opinions, but you should never invest until you've done extensive study on the company. I strongly advise you to not invest only on the basis of a tip or what your instinct tells you. Too many people have been burnt this way, and some have even given up investing as a result of their losses. Investing in a firm just based on a YouTube video is also not a good idea, unless you are willing to put in the effort to thoroughly understand it. Another sort of investor who fails is one who is continually chasing trends and hopping in and out of companies at inopportune times. Yes, you can make money, but it appears to me that the vast majority of people lose money. Those individuals are frequently skating to where the puck was rather than where it is going. Another reason why investors fail is that they believe they can predict market movements. This is a very popular one, and I have encountered a lot of individuals online who are extremely confident in their ability to get in and out of the market at precisely the appropriate time. No one has ever consistently timed the market, and you don't have to in order to succeed. That being said, I strongly advise you to compute intrinsic values for your stocks so you can determine whether you're buying them cheaply or not, since I don't consider that the time in the market, but rather buying when they're on sale. Another reason why investors fail is because they become panicked. There are excellent reasons to sell a stock, but one of them isn't because you're panicking. Plus, if you purchase and sell stocks frequently, you're more likely to accumulate short-term capital gains, which are taxed more harshly than those who buy and hold for the long term. Understanding and regulating your actions, motives, and eventually psyche is, in my opinion, one of the most undervalued components of becoming a smart investor. When the majority of people feel like rockstar investors, you know the market is about to crash. And when the market has crashed and appears to be going down forever, people are saying the world is ending and the stock market is for chumps. Well, that is frequently the perfect time to invest. But believe me when I say it is harder to do when it is actually occurring than you may imagine, even if that was your plan going in. Having a mentality of consistently dollar cost averaging into your positions is one technique to combat investing based on emotion. Another reason I've seen folks fail is due to a lack of diversification in their assets. I've seen folks lose practically all of their wealth due to a lack of diversification in their portfolio. The expense and risk of failing to diversify outweighs any potential reward from a few big wins. Diversification may diminish long-term investment performance, but the reduced volatility and stress, as well as the opportunity to reduce the danger of total loss, all seems worthwhile to me. And of course, billionaires like Buffett have a wide range of investments, including equities, real estate, commodities, NBA teams, US treasuries, bonds, startups, and so on. So I believe you should consider their statements in context. People invest in broad market ETFs rather than individual equities for a variety of reasons, one of which is to diversify their portfolio. Whatever you do, make sure you're purchasing firms that you are familiar with and that are on sale. Another way investors can go wrong is if they borrow money to invest. I advocate paying off your high interest loans first and having an emergency fund in place before investing the money you can afford to lose. The potential downside is far greater than the possible reward, and no returns can ever be guaranteed. Living frugally and continuously investing for extended periods of time in great firms you understand is an easy approach to become wealthy. Okay, I hope you enjoyed hearing about all of the reasons why dividend and non-dividend investors fail. If you have any other suggestions, please leave a comment down below. And with that, today's video comes to a close. To express your love and support for this video, click the like button below if you haven't already. Subscribe to the channel by clicking the subscribe button and turning on the notification bell next to it to be the first to know when a new video is posted. Thank you for taking the time to watch, and we hope you enjoyed yourself. We look forward to seeing you on our next video.